All righty. We'll see if it works.
All right.
All right. Well, Don, thank you for coming again to talk a little bit more about HECM's reverse mortgages. I'm Bill Fung. I'm the real estate agent, and Don is a loan officer that does mortgages, specifically reverse mortgages, otherwise also known as HECMs, which would be HECM. Last time we talked, Don gave us a brief overview of the different types of reverse mortgages and how it works. I thought this time we would go in a little bit further, and there are apparently two different types of reverse mortgages. One that's a conventional and one that is backed by FHA. So Don, tell us a little bit more about the two pros and cons, pluses or minuses, the different steps. Go for it. Pick whichever one you want to start with.
Well, let's start with the FHA product. FHA product is guaranteed by the Federal Housing Administration, and so most of the ones we do are adjustable rate products that involve future payments. That's where the term reverse mortgage comes from, is the idea of getting monthly payments from the lender out of the equity in your house. With the FHA product, the federal government guarantees that those payments will be there for the duration of the loan. The duration of the loan runs for as long as the borrower lives in the house, pay the taxes, pay the insurance, maintains the house, the loan stays in place. Otherwise, every loan's got to have a due date, and the due date on these are set when the youngest borrower turns 150 years old.
Okay.
Nobody's made it that far. So the FHA products are guaranteed. And the two important guarantees to the borrower, one is that the federal government guarantees that the money will be there even if the lender goes broke or goes out of business. And we've had, in the last just over a year, we've had 3 of the top 10 lenders in the country close up. So that's an important guarantee. The other is that the borrower will never owe more than the house is worth. So if for some reason the real estate market takes a drop and the loan amount goes above what the value of the house is, then FHA picks up the short on it, where other loans, the borrower is responsible for that short payment. With the non-FHA product, FHAs go up to about $1.1 million lendable value now for 2024. With the non-FHA product, the maximum lendable value goes up to $4 million. And so you can work with much more expensive properties on those. There's no mortgage insurance with those. There's no federal guarantee of the money being there. Typically, the draw period on those will be 7 to 10 years rather than the longer period that you have with the FHA product. The FHA product, the draw period can be 30 or 40 years.
Now, is there a difference in terms of age requirement or when you can go ahead and apply for a conventional reverse mortgage versus an FHA-backed reverse mortgage?
Yes, with the non-FHA product, the borrowers have to be 55, where the FHA product, they've got to be, at least one borrower has to be 62 or older. With the FHA product, the non-borrowing spouse can be under 62, and they've got tables down to age 18 on the younger non-borrowing spouse. If you get down to age 18, there's no money available for practical purposes, so that's not going to happen. But the common situation with the FHAs might be one spouse is 62 or 3, and their younger spouse might be in their 50s. Would be a common scenario, and so that combination makes sense on the FHA product.
Okay. So another question, as you were talking, I heard you said there's a draw period. On the FHA, it could be 30 years, and on the conventional, you said it could be 7 to 10. What do you mean by a draw period?
Well, there's a line of credit that's on the adjustable rate product, or you can have monthly payments, and those payments can last payments not to the lender, but from the lender to the borrower. You have a period of time on the non-FHA product that you can draw that money out over a period of 7 to 10 years, depending on the product. And at the end of that time, the loan will not come due, but you won't get any more money out of the product. So you've got that period of time to spend it, and at the end of that time, if you haven't spent it, you can't have any more money.
Okay, so if you have the conventional reverse mortgage, it can go up to about $4 million. There is a draw period as if it was a credit line for anywhere between 7 to 10 years, depending on the
Specific product.
specific product. So, kind of joking, you want to pull out as much money as you can in the 7 to 10 years before they say stop, no more.
Right.
Okay.
The other piece that the non-FHA products fit is that they do not require FHA approval on condos. So if the condo is not FHA approved, you may be able to get a conventional approval on a condominium. And that's where, like we did one this year that was a $3.6 million condo. It was not FHA approved, but it went through just fine on a non-FHA product is what we did on that one.
Okay. And before I forget, just again, I want to mention that this is Don Opeka. We will have his information below and links. And in the last section, or the last time we did this, Don also has a book that he has written that's available on Amazon and what else?
It's on Amazon, it's on eBay, or you can call me for a copy, and happy to send you one. Happy to answer any questions you have about these products.
So we do have that additional information. Now let's go back again to the FHA versus the conventional. Is there any pluses or minuses or any, quote, dangers that you should be aware of if you pick one or the other? I mean, if it's not over $1 million, do you have a choice of being a conventional reverse mortgage or it being an FHA insured mortgage, reverse mortgage?
Let's take a property that's worth an even $1 million. You could go either FHA or a non-FHA product. In general, the big advantage to the non-FHA product is you eliminate the upfront mortgage insurance, which on the FHA product is 2% of the property value. So on a $1 million property, that's $20,000 in upfront mortgage insurance. The interest rates will be lower on the FHA product because there is the mortgage insurance on it. And when people sit down and look at the trade-off between the two, they'll typically find that in a couple of years, the interest savings offsets the upfront mortgage insurance difference. So you're not getting out of paying it. You just pay it differently. With a non-FHA product, you're going to pay a higher interest rate. You're not going to pay mortgage insurance. And so, example, we're doing one right now for a lady that's age 98, still in her home.
Wow.
Well, our oldest borrower was 104, but I talked to the sons about whether we should do the FHA product or the non-FHA product, and they decided to go with the non-FHA product. The property's worth something over $1 million, but the big issue was that they didn't know how long she'd still be in the house, and so they'd rather not take the risk, and they went with the non-FHA product. My answer is, for each individual situation, sit down and take a look at the numbers. I'm happy to quote things both ways, and then you pick. It doesn't matter to me whether you want the FHA or the non-FHA product. It's usually more a case of which one makes sense for the borrower.
Okay. And again, a little more information if you did not see the first episode in this series. Don does FHA mortgages here in the state of Colorado. However, if you are from another state, you would have to find a lender in that state to do a reverse mortgage for you, correct?
Correct.
Okay.
And in theory, almost any lender can provide a reverse mortgage, although most loan originators are not familiar with the product. So it behooves you to find someone who's doing them on a regular basis, whether it's whatever the lender is, but find somebody that's really familiar with reverse mortgages to walk you through the process.
Yeah, and Don has done over 140, I think about 145, between 140 and 150. So he is very knowledgeable regarding reverse mortgages. Now, one of the things that we will go ahead and talk about just kind of quickly is everybody always wants to know, well, what happens once the person that has the reverse mortgage dies? What happens to the house? What happens to the mortgage? Do the heirs get it free and clear? Do they have to do some crazy somersaults or rigmaroles to handle it?
Well, all they have to do, it's a loan on the house. The loan will come due when the borrower either leaves the house. If there are two borrowers, husband and wife, then when the second one leaves the house, then the loan will come due. They've got a choice. They can sell the house, pay off the loan, walk away with money is the typical scenario. If they want to keep the house, as happened this year with one of our borrowers, we refinanced the house. He moved into the house and kept it with a traditional forward mortgage, or if the property's over encumbered, it may be a situation where you just abandon it to foreclosure.
Interesting. So there are a lot of different options or results that can happen depending on your particular financial situation, the strategy, or whatever your investment advisor or financial advisor says this would be the way to go.
Yeah, in Colorado, I haven't seen any properties that were over encumbered by a reverse mortgage alone, but what creates an over encumbered situation is if the reverse mortgage borrower is also on Medicaid, then Medicaid will pay the bills. They will allow you to stay in the house or keep the house as you're on Medicaid, but then they come back and recover against the estate whatever they've spent on the person. And that the Medicaid estate recovery claim can easily over encumber even a free and clear house. My next door neighbor was in that situation. That when they sold it, my calculation is that the Medicaid got all the money even though the house was free and clear.
So, but let me ask you this. Would this even happen if it was just, quote, a regular mortgage with Medicaid? I know we're getting into a lot of more intricate details, so I'm just asking like a general overall. Is that what Medicaid does, is that they can actually, if you had a regular house and it was free and clear, and it was in your name, Medicaid could come back and say, well, we want you to sell your house so we can get back the money that we spent on you if you're on Medicaid.
Right. Well, it occurs after you're dead.
Okay.
Okay, so is when Medicaid exerts the claim against the estate. So then what will happen is they can either probate it, or they can when your heirs sell the house, they can come back and exert a claim against the estate.
Okay.
The actual claim is against the estate, not specifically against the house. So you typically don't see a lien for Medicaid against the house, but it's when the money comes out of the sale of the house, then Medicaid goes after that money, is where that happens. And I have seen the situation where a home had a regular forward mortgage on it and a Medicaid claim, and it was not worth probating because the home was over encumbered with a forward mortgage and a Medicaid claim, and it just rolled into foreclosure.
Okay, so just want to be perfectly clear, regardless of what type of mortgage it is, whether it's a reverse mortgage or what we normal people call a regular mortgage, Don calls a forward mortgage,
right.
Medicaid could put a claim on it. I don't want anybody to think that this would only occur if there was a reverse mortgage.
No, it's nothing unique to a reverse mortgage. It's a situation where one of the things people often don't understand about Medicaid is that it's not free money there. The government wants their money back if you have some resources, and typically the house is the largest resource somebody has if they're on Medicaid. So right. They let you hold on to one car, the house, and the Christmas ornaments, maybe a boat, but once you're gone, they want it all.
Okay. And again, there is a difference between, if you're not familiar, there's a difference between Medicare and Medicaid.
Correct. Everybody at 65, everybody's eligible for Medicare, and Medicaid is what pays for long-term care when the money runs out. Typically, I don't know the exact resource limits, but something on the order of $2,000 cash in a bank and somewhere in the order of $2,500 a month in income, and that's what it takes to qualify for Medicaid.
Well, Don, maybe what I'll do is I'll find somebody who is an expert in that area
Right.
and talk to them. So we just wanted to give you some information about reverse mortgages or HECM. I'm going to let Don finish about how to connect with him. If he has an email he wants to give, phone number, a website or anything like that, and then perhaps we'll do another interview with Don in some other parts of talking about a reverse mortgage. But hopefully everybody has a better idea of what reverse mortgage is. I didn't even realize there was a FHA reverse mortgage and a conventional reverse mortgage. So that was really interesting to find out. Don, any information you'd like to tell?
I'm Don Opeka with Orion Mortgage. You can find us on orionmortgage.com. You can find me at 303-469-1254. Those are the best ways to reach me if you want some information. You can find my book at donopeka.com. That's DONOPEKA.com. And Orion is ORIONMORTGAGE.com.
Okay. Well, thank you very much, and Don, appreciate your time. And again, if you have any additional questions, call Don, or of course you can go ahead and give me a call. And I'm Bill Fung, a realtor here in the Denver, Colorado area. My contact information is homesellteam.com if you want to go to my website, or my phone number is 303-332-8035. Thank you so much. Have a great day.
Good job.
Yeah.